Hey, everybody. Happy Saturday. It is a nice Saturday after the market closed up nicely on Friday. We had a nice up day on Friday with stocks going up, and I wanted to cover that in the weekend live stream, taking a look at stocks. Now, we don't have the stock market open, so I thought we could take a look at some individual stocks and really dig in deep, kind of look at them from multiple angles, maybe do a little research, some extra research that I could slow down on a Saturday and just take a look at a company more holistically. So I invite you to suggest a few stocks that you think are interesting to take a look at, maybe some stocks that are pretty interesting at this time. And while I'm at it, let me invite you to become a member of this channel. There is a list of the perks that you'll get on the channel if you become a member. And it'd be great to have you. It'd be great to have you join the live streams regularly. Your name will be highlighted if you're a member, making it easier to pick out the members from the pack. And you'll also be invited to an investor conference call where we talk about stocks. The first one is going to be tomorrow morning, and I've already got a couple members accepted, so it should be a good call tomorrow. You'd be invited to that. So take a look. It'd be great to have you become a member, and the details are in the description of the live stream. So it looks like we've got one person on so far. Tomas, man, you are awesome. You're on all my live streams. I appreciate it. Good. I guess it's still good morning. It's good morning for me, but it looks like it's also good morning for you. You want to look at Google? I'd be happy to look at Google. And we'll start with Google. I own quite a bit of Goog, and we can take a look at that. So we'll do a deep dive. Hey, Brad, good morning. How are you? And I'm going to be multitasking here. Penn State is playing UCLA. My son is trying to complete a PhD at Penn State. So I root for a couple of universities. My alma mater, Long Beach State. I also have an MBA from Cal Poly. And then my son's at Penn State. So I'm going to root for Penn State today against UCLA. And my younger son is at Cal State Long Beach, where I got my degree in accounting. So I'm going to root for those teams. And today, at the moment, I'm rooting for Penn State over UCLA. So I like college sports. I love the NFL, and I like the NBA, and I like international football, especially around the World Cup. It's really fun. So it looks like Georgia plays at 3:30. Perfect. All right. Good luck to the Bulldogs. Hopefully you guys are there at the end and make a lot of noise in the playoff. All right. So let's take a quick peek. And I think you guys know what happened. It was good to see that the market really responded to the economic news, that the employment data came in much better than expected, showing that unemployment rate went down. And that just kind of sets the table for the economy being good. The economy is going to be good. I think stocks are going to do well in 2025. And you'll see that the two sectors that really responded to that news were right there with the consumer discretionary. It's expected the consumer is going to have more money to spend on, consumer discretionary. And I wanted to kind of follow a thread through discretionary in a bit, and then financials. So those two really, really worked yesterday. Technology, of course, is still going. Communication services as well. So there was a request to look at Google Alphabet a little earlier, and let's go ahead and get started there. And then I'm going to come back and kind of follow the consumer discretionary trend or thread and kind of dig into that one. So let's take Google, and since it's Saturday, I can go nice and slow, answer any questions you guys have, but I'm going to go soup to nuts, kind of cover the whole company and get into the model that I've built for Google. I'm a stockholder of Google, so I'm very familiar with the company. So the things that I really like about Google Alphabet is that they have really exceptional businesses. When we look at Google, they have the search business that's exceptional. It's number one. They became so dominant, the government said, hey, we think you're a monopoly, which I agree with them. Yeah, it's a monopoly. And that has made the government really monitor Google Alphabet, make sure they're not doing anything illegal, anything that really just is really over the line, so to speak. And I don't think Google's doing that. They got great algorithms. And they have the YouTube business, which I'm streaming on today. And that's now the biggest streaming platform, second to none. Netflix is actually smaller than YouTube. And YouTube will continue to grow because the content is created by the people who are on YouTube itself. So it's a really desirable business. And then they have a cloud business, which they provide the services for a company that wants to run technology on the cloud, whether they want to run a website on Google Cloud, they want to create AI apps on the cloud. Their Google Cloud business is doing really well. It's actually growing faster than AWS by Amazon and Azure by Microsoft, which are the two solutions that are ahead of Google Cloud. And at some point, it's going to get to be a very big business. Right now, it's a big business, but Google's humongous. We'll look at their financials in a bit. So those three businesses are there. When it comes to AI, Google's right in the center of AI. They have their Gemini business, which I think is going okay. Some people would argue that they probably didn't go all in early enough. And I think they did the right thing. ChatGPT had nothing to lose. ChatGPT was nothing until they released their AI app, and then they became really popular. Okay, great. But if it had gone the wrong way, they really were nothing, and they would have been nothing afterward. If people would have said, "Oh, your AI was terrible," or it created a bunch of problems instead of it being really useful. So, Google is not the first to market. They were not the first search company. They were like, I don't know, number 100, but then they did it really well, and now they dominate. They were not they acquired the YouTube business, so they didn't even start that business, and now YouTube's phenomenal. They're the third biggest cloud company behind Amazon and Microsoft. So Google is very good at, okay, we'll be the second mover, but we're going to do it really well. So the AI business, I think, is not priced into their stock. When we look at it, you'll see that the stock stands up on its own fundamentals that are based on the three primary businesses that are creating a lot of the revenue, profit, and free cash flows. So you get the AI business, in my opinion, pretty much for free. And part of that AI business, I put the robo-taxi business, Waymo, and every other bet that they're making. You get that for free. You get Google's pipeline of new businesses and ideas for free, which is really attractive to me. And it's just a great company. So Google is a $2 trillion company. So it's really, really valuable. Its revenue is $328 billion. So investors are paying about less than 7 times revenue for the company, and they continue to grow well. I'll show that in a bit. Net income is nice and profitable, and they have a lot of shares outstanding, but it's a pretty decent stock price. PE is very reasonable for a very high quality growing business, 23.5 in 2024, and it's going to go down in 2025. Analysts believe it is discounted. So it's not bad to buy a super high quality company that's growing, that is being discounted. And I'll show you the discount I'm calculating in a minute. When we look at their growth, see this 13%. It's pretty incredible that they are so big and they still grow at 13%. 13% is like a $44 billion amount of revenue. That's a really good sized company that they're growing by each year. Pretty incredible. And a lot of the growth is coming out of that cloud business, but their search business is doing great. YouTube's doing great. So those things look good. Now, as we look at, so that's the revenue. It's growing nicely. Balance sheet's exceptional. They have more cash than debt. Cash flow, this is where, as you look at the most valuable companies on the stock market, this is what you see. You see very high free cash flows that have grown over time. And this one, they've had a dip because they've invested in AI. And the free cash is cash from operations minus capital expense. Capital expense being, hey, we're putting money into the business. And they've put more infrastructure into their AI business. And I think the markets, qualitatively, market likes it. You're investing in AI. It's a really good idea. I'm glad they're doing it. But quantitatively, they're like, oh, but your free cash flow went down. To me, it's understandable. Hey, they're investing in AI. That's a really good idea. So I have no problem with them investing in AI and bringing down their free cash flow a bit. As long as their revenue keeps growing, I'm fine with that. When we look at what analysts believe, 38 analysts cover this stock. So that's a lot of analysts covering this one company. And they think it's a buy, and they think it's discounted by 17.5. They're using earnings per share as the basis for their valuation. And this year, it's $7.89. It went up from last year. And next year, it's going to be even better. It's grown by 14% to $8.98. And then the year after that, it's going to grow another 15%. So this is a really healthy business. This business is headed in the right direction. This is on my short list of, these are no-brainer stocks. These are just going to keep getting more valuable. Every pullback, I buy Google shares. I just keep buying Google shares. When I look at my investment in Google, let's take a look at what I've got invested, and then we're going to look at how I value it. So Google, I believe, is the stock that I've invested the most money into. It's not the most valuable stock. That would be Meta. But I've invested less in Meta and have a higher balance because they've appreciated better. But when it comes to Google, I've got $115,000 invested, and the stock is worth $150,000. And when I look at their valuation, all right, so recently I've kind of updated the numbers, so we should be good to go. I still think the stock price is discounted by 34%. I have a higher discount than what those analysts were covering. I research Google Alphabet 3 to 4 to 5 times a quarter. I just go into it regularly. I could see that this potentially might be the most valuable stock that from a overall dollars and cents perspective in my portfolio someday. Right now it's Meta, but if Google gets on a really good run, I could see that Google becomes the most valuable, and I'd be fine with that. I would continue to buy shares because I feel that confident about their business. Now, so it's 34% discounted. The cash flows value the company at a fair price, but it's that earnings per share that really excite me because the growth is really good in the earnings per share. And I think the PE that I want is 36 in my valuation. I feel confident behind that number because of their growth, revenue growth, where they're doing business. They're doing business in a very desirable space along with AI. And the growth, I believe, is going to be 10% going forward, which is less than what other analysts believe. But that's a number that I believe they'll probably grow at 10% or exceed it. So Google's like a really good company. When we look at Google doesn't have a direct peer, but I would say that peer companies would be for YouTube, it'd be Netflix and Amazon Video. It'd probably be Facebook to some extent now that Facebook is trying to put a lot of video on their platforms. But there's not a perfect peer because they've been so good in search that there isn't a lot of companies left in search to compete against them. So let me slow down a little bit. Tomas, did you have any questions on Goog that I could take on? Maybe drive or dig into a particular topic behind Goog. The discount rate I use on Goog, because their balance sheet's so darn strong, they have so much cash, is 7.5, which is probably the lowest rate that I use on any company. As interest rates continue to drop, let's say in a year or 2 years, if interest rates were like 2% down, you're going to see my discount rates go from like 7.5 to 6.5, because that's an adjusting factor based on current interest rates. And Goog, when interest rates were really expensive, I was discounting it by like 8.5, which was the best rate I would discount a company by. So that's where the discount rate is coming in. All right, so that's Goog. It's one of my preferred stocks to continue to buy into. I continue to buy shares into the company. It's just a really, really good stock for me. They're always in the news, and there's just too many topics to take on. Just the things that are exciting to me are like Waymo, the Waymo business, really exciting because that's a real robo taxi business. It's operating right now in multiple cities. And Tomas, I would like to dive into which of their main revenues. We'd like to dive into which is their main revenue source. All right, let's take a look at that. Before I jump into that, I'll just finish my thought on Waymo. So Waymo, they formed a partnership with Hyundai for EVs because right now they are in partnership with Jaguar. And I believe those Jaguar vehicles are internal combustion cars that get gassed up and then voila. So the other company they've now formed a partnership is Hyundai with the Hyundai EVs, which is kind of an SUV. I think it's the something Ioniq 5, I think, is from Hyundai. I've seen the car; looks pretty cool. So that's exciting. All right, so let's get into the company's financials, and we'll go direct to their investor page. So I'll go to Goog Investor Relations, and we'll crack open their financial statement and kind of look at the revenues and kind of dig into what's their principal revenue source and kind of analyze that. So the 10Q is released every quarter by a publicly traded company here in the United States. So that's going to give us our financial statements. Let me make this bigger. Here's the balance sheet. And here's the income statement. So here are revenues, right? They've grown nicely. And this is for the first 6 months. So for the first 6 months, they grew over about 21 billion multiplied times 2. They're growing at like 42 billion for the whole year. And let's see if they give us additional detail. While I'm here, I'm sure we're going to get to the breakout of revenues, but when we look at 165, cost of revenues is 69. So their gross revenue is like 96 billion, which is a very good gross revenue. They're putting R&D back into the business, sales and marketing, general and administrative. So it leaves a really nice profit margin left for the company. Okay, so we have comprehensive income. Let's look and find. Here's owner's equity. Just Statement of cash flows. All right, let me go back to the table of contents and see. So I'm not sure I'm getting the breakout in revenues here. So let me see if their main presentation deck. Here we go. Here we go. I was giving up too soon. So here's the breakout of revenues. Okay, so this is their main business is the search business, and the search business represents 94 billion of the 144 billion. So that's a pretty good amount. YouTube ads, which is very profitable, 16 billion. And then this is the Google network. So Google Cloud. So this is services, then cloud's down here. So Google network, I think, is all the other services. And I think that's like, I think it's for storage, like all kinds of stuff. Subscription and platforms, 18 billion. Yeah, that's really good. So that's where their principal businesses are. And the thing that Google only takes on businesses that are going to have very good margins. They don't take on businesses that are going to be really low margin. Very, very desirable. Every business, like subscription business, high margin. Ad business, high margin. Search, high margin. And then this business, this is the business that's growing very fast. If you look at the first 6 months of 2023, the Google Cloud business was only 10 billion. You can see here, it was 10 billion for the first 6 months. And then for the first 6 months of this year, it's almost doubled. And that's a very profitable business. So they're growing much faster than Amazon with AWS, Azure. At some point, this is going to be like 50 billion, 75 billion. And it's a really nice growth catalyst for the company. And this is where if another company wants to do AI, they can go to Google and say, hey, I want to build my AI platform on Google Cloud. This is where they would go. And I think the AI business they run, Gemini, is going to be, I'm not sure where they're going to put that. Maybe in advertising up here somewhere. Because it kind of resembles AI. Gemini resembles the search business, and it's coming up. When I use search, it always comes up. Gemini comes up. So, and then so other bets. So that's the breakout of the revenue. The one lesson that I would encourage you to take from looking at Google, it's really spend quality time with quality companies. So you know what the gold standard looks like. Hey, this is an awesome company. Let me go find another company that's younger, smaller, unknown. And then I could, bet that that company is really going to explode in value. So one, this is a good investment for me, Google stock. Two, this is the gold standard. When I look at Google, when I look at Meta, when I look at Microsoft, those are just quality companies. And it really should leave an impression on me. And I encourage you to really think about, okay, that's the kind of business we're looking for. We're looking for a business that looks like this, that has just such a great strategy, that has these businesses that make really good margins, great cash flows. They have great competitive barriers. They're so good that the government calls them a monopoly because they're so good. They were not the first ones to search. They were like company number 100 into search, but they did it so well. They outperformed everybody else. So James Greaves became a member. Thank you so much for becoming a member. I really, really appreciate that. I really appreciate you becoming a member, and please send me your email however you can so I can invite you to the member conference call. Tomorrow, we're going to have it every week if you can't make tomorrow's, and then I'll give you access to the tools that I use when I analyze companies, but I really appreciate it. Thank you. So looks like back to Google. Brad, it's your largest position. I know another like good sign is that when you look at super investor portfolios, which I do look at, it's good to see like, hey, how do they do it? You see Google a lot. I mean, super investors are not dumb. They're like, hey, that's a good company. It's kind of like a solid performing company. And then they go try to figure out, how could I go find another company that's going to perform really well? And then Lighter Martinez, Google is investing heavily in energy. You know, I haven't, that's it. That's an interesting statement. Do I have Gemini available? Here it is. So let me use Gemini and ask, how is Google investing in energy? Are they building? So they're investing in clean energy. Are you referring to like, hey, they're going to be building nuclear, power generation in partnership with somebody else? Because I have heard of a lot of that. I think Microsoft is doing that, and I wouldn't be surprised if Google is doing it, which is, hey, they're going to need a lot of power for AI. I think that's where you're going. I have heard of that, but I haven't seen like a real business like, oh yeah, this is going to be Google electricity or something like that. But thanks for bringing that up. I was talking to my son about it earlier today, about power generation. All right, so let's look at earnings release, stay on Google a little bit. And then if you guys can think of another company, I'd be happy to get into another company. I'm also going to, looks like Lighter Martinez, Noble Corporation. So maybe Noble Corporation, forgot what they do. I think they do energy services, but we'll take a look in a bit. So the earnings in Q2 and their next earnings is going to come out October 22nd. So that's around the corner. That's in about, we'll call it 2.5 weeks. And this will be one of the big earnings, right? And it'll really be looked at. I'll be looking at it and most definitely commenting on it. So one thing I haven't looked at is, this stock really has been taking care of business. It's up 183% over 5 years. I dollar cost average in my investment. I bought here, I bought here, I bought here, I bought here. I've been buying here. I just buy more Google. I just want to keep accumulating Google stock. Okay. All right. So that is Google. And I think one bonus that I'll put out there is that which company reminds me of Google that's smaller, younger, and less valuable? And talk about Microsoft. Yeah, I can definitely talk about Microsoft. So the company that I really like is Uber. Now, Uber is very big in revenue, 40 billion at this point, and they're fairly young, right? And their stock's really working, especially around the last year. It's up 66%, 5 years, 149. And Uber is an example of a younger company, and it's also an example of, I don't buy IPO stocks, because even Uber, when it IPO'd, it fell in value. If my memory serves me right, if you would have bought, so here's when it IPO'd, and it really fell a lot. So you'd be sitting there, first 9 months of owning the stock, you're down 48%. It's like, oh my God. And then the business to me wasn't ready to be, it wasn't investable yet until I started investing at the right time, like around here. And it's really been working over the last couple of years. If you go back to 2022, it's up really nicely. Now, why do I think Uber kind of reminds me of Google is they're outperforming everyone in rideshare. I think the experience, just based on market share and growth, they're the ones that are taking the lion's share of that market. And that's kind of the entry into other businesses, food delivery, autonomous, robotaxi. Uber's already signing agreements with other companies to do the autonomous piece. And they have the platform. They have the biggest platform and network for ride sharing. So that's a huge advantage. That's awesome. So to me, Uber, their experience in how they grow and how they provide experiences to their to the many platform users is really high quality in my mind. So they remind me of Google. And I would not be surprised if Uber is 5 times bigger, like 5x over the next 10 years. This is definitely a stock that I believe is going to exceed my expectation that, hey, I want this stock to double in value in the next 5 years. I think this stock's going to do better than that. I just think that their business is a new business. It's disrupting old businesses like taxi service. A lot of young people, they don't buy cars because Uber is so reliable now. They can take mass transit and Uber when needed, and they avoid car purchase, car insurance, maintenance on car, storing the car, because sometimes that's a pain in the neck. You don't have to pay for parking. You don't have to pay for storage, all that good stuff. So Uber reminds me of Google, but it's younger. It's kind of beginning to become, a pretty good sized company, 156 billion. And if you look at their stock, right, they were down quite a bit. They were down to $21 a share, and they're up really, really nicely. So I like Uber, and I like Uber because of those abilities to really dominate the markets they're in. I think the user experience is exceptional. They're getting into businesses that are becoming more and more profitable. When we go to robotaxi, Uber has the biggest network of people that want to hail a ride. If somebody else wants to start a business, they're going to have to get their customers. That's going to take a while. Uber has the customers. They can, boom, start on it very quickly. Hey, Mike, good to see you. Thanks for joining. Take a look at ALB. ALB's gone up 20%. We looked at ALB, and let's take a look at it again. Okay. Thanks for joining, by the way. Shadow Guy. So ride sharing is huge. Yeah, I don't go to Europe every year, but I've been to Europe. I was there in 23. I was there in 19. I consider myself really lucky. I took a really nice trip to Europe on 2019, and then everything got locked down in 2020. And then I did Mexico City and other parts of Mexico in 23. End of 22. I did Mexico City, Mexico. I did a couple of cities there, and Uber was everywhere. It was everywhere. Where was the one place that I hailed a ride using Uber? Italy. So in Italy, I used Uber, but I guess in Italy, they require that Uber use the taxi network, but I still used Uber. I was using the Uber app, which I trust and depend on. But in Germany, Uber, I didn't use it in UK. We used all mass transit and foot. We just did London and UK. Belgium, Uber. The Netherlands, Uber. And then last one is we went to Prague, and we used Uber there. And the only funky thing is, like, when you go from country to country, it uses the currency of that country. And when we went to Prague, they're not on the euro, I don't think. So that we used the Prague currency. And, you pay for a ride in the US, right? Oh, okay, that was $20. Okay, cool. But when I went to Prague, their currency, it was like, okay, you just paid 3,000 of their currency for the ride. And I'm like, whoa, Hopefully that's not a lot. And then later on I found out, oh no, it was like $5, $10. Okay. No worries. It just looked like a big number when I would see it on the app. So, um, so Uber, I think, has got a long path ahead. And then I hope you bought Uber in August. Yeah, I've bought into Uber. Let's look at the 1 year chart. So these dips, you better believe I bought into it. Yeah, when I see these dips, I'm like, yeah, thank you for the discount. I would gladly buy it. Now, when I value Uber, let's take a look at the valuation. Now I'm gonna get to ALB, Mike. Hang in there with me. Let me just finish my thought, and then we're gonna get on ALB. We're gonna dig into ALB. We're gonna do everything short of calling the CEO and asking him for some information. Which, if anybody has their number, I'm game on doing that. If you got his number. Oh wait, what am I doing? Trying to look for ALB. I don't have ALB in there. So Uber, right now, I think Uber is discounted at 13%. I'm valuing their cash flows, their earnings per share. When are they going to announce? So they're going to announce on November 5th. So it's going to be in a month. And I think the stock is like, if I see a pullback on Uber of 2-3%, I can't resist. I buy some shares. It's just a stock that I want to own a lot of shares in. And when I look at what I'm holding for Uber, it's not quite as big as, Google or Meta, which is so recognizable. And what's funny is it's an industrial, right? It's an industrial stock. It's a new industrial stock, but I own 77,000 of Uber. Totally comfortable with that. I'm willing to go 100 grand. I just want to see an earnings, and happy to own that stock long term. That's going to be a good hold for me. All right. So let me get to ALB. So ALB. So manufactures specialty chemicals, and it's in storage. It's in lithium. Recently, it's gone up nicely. So what is kind of unusual, or I would say surprises me, is I happen to think that lithium, I should say battery storage, is incredibly important. Like, that has to be figured out. But I think somebody on another comment said there may be a new technology or a new chemical or material that's going to be better. So it's going to leapfrog lithium. So I think we got to investigate that, make sure, was that just a story that doesn't have a real use case? And it's just a story. Or is it real and we have to be aware of that? Hey, am I buying into a technology that's going to be completely replaced? So that'd be important. Okay, so let's take a look at the presentation. I'm not that familiar with this company, so it'd be a nice exercise to kind of get really familiar, and then I'll do a complete valuation. I think I've done valuations on this, but let's do it again. So they're in energy storage. Volume growth, 37%. I think the commodity price for what they sell has gone down. So it may not show up like that on their income statement, but it's good that they're growing their volumes. So sales has gone down for Q2, 40%. Let's ask, we'll stay on Gemini. And we'll ask how lithium prices from a commodity perspective have been. All right. So lithium prices. Weird. It didn't show me like a nice breakout. It's saying go here. So let's see. Let's go here. So here's lithium. See the price is what's burdening these companies. That's one day. Okay, let's change it. So let's look at the 5-year. Okay. So you see how, wow, man, what is going on here? It was really high and it's really collapsed. Here's the story, right? If the commodity is not going to rise, this is going to be a tough investment. And why isn't it rising anymore? I would think that there's a lot of demand for that particular commodity, but there isn't. So, Mike, do you happen to know like what's going on with this commodity? Why is it so low? What's the story behind it? Why isn't the commodity, rising? Because I know that we're using batteries for so many, things, and so many products are being, moved from internal combustion to battery. Gardening, um, machinery like lawnmowers and all the things, to landscape, that's totally moving to battery. So you're saying it's expected that this commodity is going to improve later in 2025. So let's see if these smart AI apps are going to give us an advantage. So I was not impressed with Gemini with that response. So let's go to Meta. And I'm going to ask it, what is the forecast for commodity? All right. So it didn't give me a really great answer. It did say, these are the links there. So I think to understand ALB, it looks like the company's operated well because they're growing their revenue, their units. You have to understand the commodity. So I would let me ask another question. So is another material going to replace lithium? So lithium's reign as the top battery storage material may soon come to an end thanks to several alternatives that are gaining traction. Sodium ion batteries, lithium sulfur batteries, solid state batteries, zinc ion batteries. I have heard about solid state batteries, and there was some instability factors that kept that from being a great reliable battery storage. But I have to think with time they're going to break through and make that a very stable source. And there's zinc ion. So this is the biggest area of homework for the ALB, stock, is get to know this space. And I think it's interesting. We're going to follow this thread, and we're going to look at sodium ion battery companies and see what they look like. And then we can go from there. So let's go look at this guy here, and I want to leave that open. Okay, who's making these types of batteries? And I didn't ask my question well enough, so I can just copy it. That are publicly traded. That way I know where I can look at a stock. Okay. So here they are. So this is one company in the UK, one company in Japan. Now I'm familiar with this brand. These guys have been around for a while. And then Freudian. Okay, so let's go down a couple of threads here. So we're at ALB. They're in the lithium battery business. I think they're well operated, but they may just be in the wrong technology, using the wrong material. Let's take a look at some of these companies and see what they're all about. Safety Power PLC. I'm not seeing it. It's in the UK, but maybe I'm not scrolling down enough here. Okay, so I'm not seeing that one. Let me move on to the next one, because this one, it does look familiar to me, because this company I know makes spark plugs. I've seen their spark plug brand. They make automotive parts. So it makes sense that they want to get into the battery business. They've been in the, business before. So this is in Tokyo. Company hasn't been doing much. It's not doing all that great. So this is in yen, and I think I used the wrong symbol. So it's JST. Yeah, I used the right symbol. Okay, so it's 0.028. So it's this number. So it's almost like 3% of that number. So this is, I don't know, about 15 billion market cap. Revenues about, I think about 1.5 billion, 2 billion. So this company's out of Japan. So you'd have to be comfortable investing in Japanese over-the-counter stock. And I don't even know if I can get this over the counter. It doesn't seem to be over the counter. It's in Japan. But I would follow the thread. It doesn't seem like a big company's in there, like a Siemens or some big giant company where it'd be like, oh man, they have plenty of resources to compete against ALB. So there's some companies, small players. That's the big story that we got to track to know if this is a good investment. Is, are they in the right material? Will they get into this other material that's going to be better? So that's the big question. If you can try to figure that out, I think if you can look at the qualitative story of, are they in the right material? Is that market going to keep expanding? Are they in a market that they can really grow and become massive and really valuable? That's the question that has to be answered on this company in order to get to the next step, which is, okay, the stock is good stock for a good company that's going to keep growing. Now, what price do I want to pay? But I have to buy into the story first. And right now, there's just too many open questions. The biggest one being, is the material that is being used going to be replaced? And it seems like there are some contenders to replace lithium. I'd have to get my head around this. And whoever wins, whichever material ends up being the best, then try to find the companies that make batteries based on that material. Maybe then, okay, well, where are we going to get this material, right? Are there going to be some miners that are going to participate in that? All those things could be in play. So that is ALB. I think from what they're doing, I think their business, they're operating it, but geez, man, the commodity price, it's come down less than half of what it was selling for a year ago. The commodity has collapsed. It's now selling for less the commodity price that was being sold less than a year ago. That's big concern. That's big concern. So that is ALB. And Lito, just to put one more comment out there. Yeah, Toyota they're investing in hydrogen engines. Now, I don't know if that's going to make it. I see them, right? Just the distribution of hydrogen fuel is not great. I think if you buy a car, I'm in Southern California. We have a lot of people living here. So there's plenty of people. And it's really inconvenient to go to a hydrogen refueling station. They're not everywhere. They're actually, before you bought a hydrogen car, you'd have to know, where am I going to go fill up? That'd be a really important question. But I think you're right that there's alternative ways to get people to drive other than internal combustion, gasoline, or diesel cars. All right, good stuff, guys. We'll go down some interesting threads. Let's take a look at Noble and see what that's all about. So Noble, I know we looked at it in the last month. I just forgot what they were. Yeah, okay. So they do offshore drilling, okay? So they're a little bit like Pump. Pump does fracking. So when oil prices go up, this company is going to rally, because with a higher oil price, that means that oil companies are going to contact Noble and say, hey, we want to do more projects because we want to sell more oil with higher oil price. So Noble, now the projects these guys do are not easy, right? Once you go offshore, it gets much more difficult. But these guys already, in the oil business, the oil company, they have a lot of very smart geologists that will figure out the best reserves for oil are in this location. And then they hire somebody like Noble and say, okay, drill into that location. We think the oil is at this depth, under the crust, whether it's in here, it's under the ocean. So once you get to the seabed, you'll have to drill 1,000 feet, 2 miles, however many feet you're going to have to drill to get to the oil. And they prepare that site for extraction. So that's what they're all about. These guys, probably in Texas, they've been around since 1985. All right. Just to give you a quick view of what they do. Nice picture of the ocean. The other thing that I imagine these guys get involved in, we just had a massive hurricane go through the Gulf. Well, what if it damaged a bunch of those oil platforms that were out there? What if oil companies have to call Noble and say, hey, we need you to fix or repair this particular oil platform because the winds and the water pressures and so forth, detach this particular platform. That could also be something that's going on. So that's what these guys do. It's part of the oil complex. It's a $6 billion valuation company, nice and small. Revenue is 2.5. When I get to revenue, I'll be curious to see how consistent their revenue is. I'm going to guess that it's going to be a little bit of up and down based on oil prices, but let's take a look. So they're profitable, really nice profit, very nice. And PE is really low, 9 for the current year, 10.8 for the future years. Dividend, really nice dividend at 5. They're a buy with a huge discount from, according to their earnings per share. Now, for the 1 year, they're down 25%, right? And it's following oil. Remember, like a month ago, this community, we were talking about oil. Oil is down, but it's not going to stay down forever. So it'd be a good idea to kind of look at oil and see if maybe we can take advantage of that low oil price, which is going to cause for low stock prices for companies in the oil business. And Shazam, they've been rallying more recently. This stock has been rallying. Now it's not breaking any records. The one thing I've noticed in oil prices is the price of oil has really gone up quickly, like 2-3% a day, but stocks were not rallying to the same ratio. So I think the market's kind of waiting and seeing, like, what if, I think the market may be suspicious that we're having an oil price increase that is going to be short-lived and it's going to come down soon. So they want to make sure that, hey, this thing's for real. We're going to have oil prices that are going to stay at an elevated level for a while. Well, if they stay elevated for a while, these stocks are going to keep rallying. And especially if it keeps increasing. And what's made the oil price increase is the tension in the Middle East. So this one here, and I don't know what oil prices are doing. I don't know that they update these numbers, but see at $74 a barrel, it's up nicely in the last 30 days. Not too long ago, it was at 67. Beginning of September, it's at 65. Now you're seeing about a $9 increase. I mean, $9 is 15% rise. But the market doesn't want is for the price to kind of do a head fake. It goes up and then it comes back down. So I think that's the market's kind of playing it safe. All right, so that's what it's done. Looking at the revenues, very impressed that they keep their business in the green. Man, I'm very impressed. They continue to provide services, even though the oil prices really dropped. These higher oil prices should keep the oil companies motivated to, continue to drill in the Gulf of Mexico and other places. So that looks good. Balance sheet, 162 million in cash and short-term debt, and cash and short-term investments. I misspoke. Sorry. Long-term debt 622. So about, I'm just going to round down to 500 or so. And when I look at earnings, EBITDA, yeah, they've got a good balance sheet. Good for them. They're in somewhat of a cyclical business, so they shouldn't carry a lot of debt because they could go bankrupt if they're carrying too much debt. Very good balance sheet. Good quality balance sheet. Free cash flow, it's been positive, negative here, positive, positive, positive. They probably put a lot of capital into their business, a lot of capital, but now it's positive there. So this is a business that I would multiply times 10. So this is worth $1 billion, $1.2 billion. And wow, they're valued at $6 billion. So why are they valued so high? Is this quarterly? So annual. I think I looked at the quarterly. Let me look at that again. Nope, that's for the year. So 113 free cash. they've never been a high cash flow generating company compared to their market cap. If it's 6 billion for this type of business, I expected it to be around 600 million, and it's only 113. So this would not value up to its current market cap for me. I think the revenue growth has impressed investors, and they're valuing it based on earnings per share. I'd pass on this stock because the cash flow is not good enough. That's one of the qualifiers that I have. But I think that analysts are looking at their earnings per share, which is growing nicely, and then valuing the company just based on earnings per share. And that's how they arrive to the stock price and actually say, hey, it's really discounted. If you just look at earnings per share, and I don't just look at earnings per share, I look at free cash flow as well. So this one's a pass for me. I can find other companies in the oil business that are going to give me a very good cash flow rate, and I'd rather buy. So those are my comments there. Not sure where the stock's going to go, if it's going to rally or not, but I know that Pump has better numbers than these numbers, especially on the cash flow side. So I'd rather go to Pump instead of Noble. All right, so let's take a look here. So I think I'm up to date on comments. All right, so just to give you a heads up, I think we've been going for about an hour, which has been great. I'm going to do a video on financials, and I'm going to drill into the financials sector, and I'm going to do a video on consumer discretionary and drill into these two sectors. Let's kind of get into this thread really quick. So consumer discretionary did really well in the first 9 months of 2024, and it did okay in 2023 as a whole. Now, the biggest company in consumer discretionary is Amazon. Great company. I'm buying into that stock. Tesla's in there. Home Depot's in there. Baba's in there. Toyota, McDonald's, Pinduoduo, bookings for travel, Nike, those types of companies. And it is, I consider it kind of a collage of companies. Some companies don't kind of, operate, the companies don't look alike. Very different in companies, right? From travel for booking as an example, and then you have a car company. Airbnb, travel, then you have an e-commerce platform like Amazon. But there's some really good companies in here that are worth considering. And I think now that the economy is going to be good in 2025, that's the expectation. I think consumer discretionary is going to continue to work. What is also going to work is small caps. So it might be a good idea. Let's go down to like, I don't know, $10 billion mark and see if there's some interesting stocks we can take a look at. I'm not going to look at GameStop. That is not one that I want to look at. Now, Mohawk does home improvement products like flooring and stuff. Is that interesting? Well, let's look at a couple more. Maybe it's interesting. Hasbro, they do toys. Skechers does shoes. Rivian had a bad week. We looked at Rivian yesterday, the day before. My conclusion was I'm not going to invest in it. I think they're going to have trouble. They're burning cash. They're downgrading their forecast for revenue. Those are all bad things. Magma International. Let's take a look at that guy. Floor and Decor. I've seen their stores. I think consumers have really improved their homes, and they're not going to improve them for a while. I mean, how many times can you remodel your kitchen or your bathroom? Once you do that, it's like 10, 20 years later, you think about it again. And if you're like me, we remodeled our house completely like 24 years ago, 23 years ago. No, about 20 years ago, excuse me. And we're not going to touch it again. I mean, for one, I just don't like the inconvenience. And then two, it's like the stuff we have works just fine. So, all right. So Kava, let's take a Kava. The home builders haven't been doing all that great. I don't know what on hold does. International paper, does it really belong in consumer discretionary? I don't think so. Genuine Parts Company, let's take a look at that. TXRH. What does TXRH do? So let's TXRH. Okay, we'll look at one restaurant. I'm not big on restaurants, but we're going to look at it. All right. So these are some companies we'll look at. They're smaller in market cap, so they're not going to be these big, massive valuation companies. They're lesser known. That's fine. I think that companies that are in the small and mid cap space could really start performing, and we will see. All right. So looks like, Mike, you're also into Texas Roadhouse. So Texas Roadhouse, let's take a look at their growth. Growth has been really good. Very good. And annual, they're a $5 billion company. And I don't know that I've ever been to a Texas Roadhouse restaurant. Headquartered in Louisville, Kentucky. Oh, man. Now I'm going to start getting hungry. That looks pretty good. Very good. So steaks, salmon, shrimp and steak. Nice. Sit-down restaurant. Looks good. Okay. All right. So that's the type of restaurant. It's a sit-down, full-service restaurant. And it's been growing really well. They're probably opening locations, right? I'll take a look at their actual earnings release, and we'll look at their the details they provide in their earnings investor page, and we'll know if the growth is because they opened new locations. We'll also look at same store sales. All right, so the company is 11.9 billion, 5 billion in revenue. PE is a little high. I think that growth is what investors are excited about. They're a buy, but they're priced a little bit high. The stock's really performed well. Looks good. The growth, we went over the growth. That looks great. Cash is 197 in cash and short-term investments. Total debt is 807. Doesn't seem like a lot. So when I look at it, it's like 600 net debt once you deduct the cash. And we get to, they can pay off debt in like 1 year. So very good balance sheet. So they're growing, and they're growing without the balance sheet getting too much debt. Debt is bad, very bad. If you have excessive debt, it's really going to handcuff the business. So looking at free cash flow, 306 million, and it's grown nicely. See, I'm confident in their free cash flow projection because it's grown up. It's grown nicely over time. I would probably say this number times 15. For an industry outside of restaurants, I'd probably go 20. We'll go to 20 because I don't like restaurants, but maybe you like restaurants. So that would be about it. So 300 times 20 would be about 6 billion in value. And their market cap's 12 billion. So investors really like the growth. And Texas Roadhouse is it's a business that the average retail investor and most investors can get their heads around. Like, hey, I understand their business. It's a good idea. I'm going to invest. But I find the stock to be overly expensive. I'm only valuing the company at half based on free cash flows. So it'd be a pass for me. Analysts think it's a little bit too pricey by 4%. And the future growth doesn't look all that exciting, right? They're going to grow their earnings per share by 9% in 25 and then 15% in 26. The revenue is slowing down, but it's still green. It's still growth. So that's good. It seems like a good business. It's growing. People like the food. People like the experience when they go to their restaurants. All those things look good. It's just not really valuable to me. And I would not buy, but I kind of play with my cards open. I don't like restaurants. I bought Starbucks recently. That worked out nicely. But now that you have, consumer discretionary working, maybe this stock will work. And if you think, hey, this is going to be a stock that, investors will favor, I can understand that. But I would be a pass. I don't see enough value there. I see an expensive stock. Yeah, Mike, good to see you. Thanks for stopping by. And I appreciate it. Thank you. All right. So we looked at Texas Roadhouse. So Magna, I think they do. Aftermarket automotive parts. And I'm sure they also do some original equipment that would go into cars. This is like people that want to personalize cars or maybe recondition a car. They would look at Magna. Performance-based products and stuff like that, or high-performance products for automobiles. It's a $12 billion business. Wow, big revenue. $43 billion in revenue. Dividend was 4.6. The stock is down. It's down pretty hard. Analysts say it's a buy and it's discounted by 25%. The business has been growing. Wow, why is it not a lot of love going to this company? Now, I can understand the most recent quarter is flat, but all the other quarters are green. So that's Magna. The cash is $1 billion and total debt is $7.46 billion. So about $6.5 billion of debt. So they can pay off debt in 2 years. Okay. That passes that test. Now the magic question, how much cash do they produce? So they were producing a lot of free cash back here. And they kind of hit a point where their free cash flow started to really drop. Interesting. So 8.3. They're not really growing. So I'd probably be interested at like 10 billion, 12 billion would be a high point. So they're priced fairly. If the prospect is for them to start growing quickly, this might be interesting. But for now, it's actually priced at a little bit of a premium based on cash flows. And I can understand if earnings per share have a higher valuation, but this one doesn't look all that great to me. So it's a pass for me. And then Cava, what does Cava do? So this is a restaurant. Okay, this is the healthy restaurant company. And I think they've been growing nicely. I think I've seen them in the news. And yeah, they're growing nicely. They're small. They're growing nicely. I think they are. So the stock price is up. Wow, look at that. 322%. Wow. So in this particular space of restaurants, it looks like investors really fixate on revenue growth and earnings per share. And these companies are doing both. So it's almost like this particular industry and sector, they don't align really well with how I look at companies. So this one is growing really nicely, but I doubt that I'm going to go. Look at this PE, 339. Incredible. Okay. So you have a restaurant that is doing 845 million. you're paying about 17 times revenue for the company for a restaurant. At some point, the growth is still there. It's very impressive that they're growing that much. It's not giving me the quarterly. There we go. So the quarterly looks really good. So the growth is going to persist. So they're probably going to be a $2 billion company in the next 5 years or so, which will be good. The one company that I would compare them to is Chipotle, right? And Chipotle's stock price has really dropped ever since the CEO decided to leave. That would be more this would be a more desirable company to me because this is a proven model. This is a proven company. They are nice and they're much bigger, 10.6 billion. They continue to grow very nicely. Quarterly looks really good. And if we look at the 1 year, it was doing really well. And then the CEO left. Well, we're being offered a really nice discount. I'm not buying stock in a CEO. I'm buying stock in Chipotle potentially. So this company has a high PE. And again, it's one of these stocks that investors can put their heads around. I know what Chipotle is. I eat there. I think it's a good model. I do like their model that it's simple. It keeps its cost down. I think other places are trying to copy their model because they are successful at it and they have good net income. So Chipotle is good. Let me look at their free cash flow. I think I get it here. Free cash flow 1.3. Good growth. I'd probably pay like $26-30 billion for this business, and it's way above that. So I'm not a taker of Chipotle. I wasn't a Starbucks stockholder. I just sold my Starbucks stock because it just increased way above the intrinsic value that I calculated for Starbucks. And I wanted to concentrate my portfolio. I'm glad I did so because now I have plenty of cash to invest in China stocks. So both Cava and Chipotle are not good for me, but investors are buying into Cava because of that revenue growth, and the earnings per share look pretty decent. Genuine Parts Company, I believe they do automotive parts, replacement parts. Okay. That's really become important because cars are so darn expensive now that I think people are keeping their cars longer and just keeping them running. So this company continues to grow, but they're not growing very quickly. But they are growing. But back in the COVID days, look at these growth rates. Nice. Okay. 19 billion, revenue 23 billion. PE is nice and low, dividend, and it's discounted according to analysts based on earnings per share. Stock is kind of even for the year. It's gone up nicely over 5 years. It was going up really nice up until 2022, and then it started a downward trend. All right, so balance sheet, cash is 555, and then we've got debt at 5.2, so about 4.7 in net debt. So they pay off debt in like 2.5 years. So balance sheet's okay. It's under 3 years. Now, when we look at cash flow, free cash flow has always been positive, very good. So this business is worth 10 to 15 billion, and it's valued at 19 billion. Yeah, this one's not exciting to me. If they keep dropping, maybe, but it's not exciting to me. So I'm not finding any like diamonds, no diamonds in the rough, but I'm going to keep looking. The stocks that I own that we're looking at consumer discretionary. So consumer discretionary, I own Nike, Alibaba, Amazon, and Airbnb. And I think that's a good mix, right? One apparel company, two commerce companies, and then uh, a travel stock. So I'm good. It's not like I'm starved for consumer discretionary. Those are the ones that right now I'm buying additional shares in Nike, trying to build a good position there. I've got plenty of stock with Airbnb. I'm good there. And I'm building up a position with Amazon. I'd like to get that up to 100,000. So I'm good with consumer discretionary, and I'm glad that space is really working and investors are piling in. MGM. So you want to look at MGM, and I don't want to jump to conclusions, but I believe they do gaming, right? So MGM Resorts International. Yeah. So they do big properties, destinations, and they also have gaming at those properties. So let's take a look at that. So I was in Vici for a while. I thought it was good. Made some money on Vici. They also pay a good dividend. This one here, Vici owns a lot of properties like on the Las Vegas Strip. These guys actually operate those properties and they provide, the experience to customers that travel to their destinations and stay at their resorts and gamble in their casinos. PE looks good. Forward PE looks good. Nice low valuation, strong buy, discounted. Since we know the consumer is going to be okay, I think they're going to be open to gambling and having a good time. These guys are growing nicely. So that looks good. Balance sheet, 2.4 billion in cash. Total debt, 32 billion. So let's call it, they have 30 billion, which is kind of a lot. 30 billion in debt. Their EBITDA is, yeah, their debt's too high. 2.55 billion in EBITDA, and they have a lot of debt. So when we look at interest expense is 440 million on that debt, which isn't as bad as it was in 2021 when there was higher interest rates. Okay, so looking at their debt, why is their debt so high? So their debt was 15 in 2019. They went into COVID. Maybe they got into trouble and they had to start lending or borrowing. Excuse me. Yeah, they have too much debt. This is too much debt. They'd be paying off debt like in 10 to 12 years. That is way too much debt. The stock that I do like, it's not going to be classified as consumer discretionary, but Vici is a good stock. This is a good company. Growth. They're a REIT, so I don't look at the balance sheet because they hold a lot of debt because they own a bunch of real estate. And they pay a nice dividend. What have they done? It's a decent rate of return. You could see that at times you could really buy this stock discounted. You can see that people are going to Las Vegas or wherever Vici has properties. This is one that I'd rather own Vici versus MGM. That's where I would go to. So looks like Brad wants to take a look at HVT. Haverty Furniture. Okay. So furniture. So the consumer is going to have money to spend. Let's take a look at their growth. So they had negative growth. Then they had really good growth in 21, modest growth, bad growth, bad growth. So we're dealing with a contracting business, and their business, when I look at trailing 12 months, $793 billion company. It's million, excuse me. In 2019, before COVID, they were bigger, slightly, but they were bigger. And that doesn't look good to me. They should be bigger than the 2019 number. I give them a pass completely on 2020. People were dealing with COVID. They were scared. They didn't want to buy big ticket items. I got it. No problem. But 2019 had no COVID impact. That was a little bit higher than your trailing 12 months. So I have a problem with, why is their business not growing? Over 5 years, they haven't, the outcome is not overall growth. That's a big red flag for me. That means their customers don't appreciate their products enough. They don't like their products. They don't like the experience when they go in their showrooms. Something's wrong. That's an initial red flag. Let's take a look at balance sheet. 100 million. Net debt, 213. Okay, low debt. Very good. I'm pretty sure they're going to be able to pay off that debt very quickly. Yeah, they'll pay it off in less than 2 years. Low debt. Very good. Free cash flow. It's good that they're all positive, but that first, looking at revenue, the health of the business, it's not there. It's like you should be expanding from 2019 to 2024. There should be you should be 20% bigger, if not 40% bigger. So they didn't show that to me. So I'm nervous. I'm like, this business is worth like 400 million in my mind. And that's where they're priced. It's 400 million. But high level qualitatively, I'm not buying into this business. I'm a pass just because, okay, the revenue isn't growing. People don't like something about this company. People being the customer. The customer doesn't like their products. They don't like the company. They don't like the showroom experience. They're in the wrong cities, the wrong locations. Something isn't right. Okay, so that is HBT. All right, so I'm going to probably cover this one from Tomas and then wrap it up. BG and J&J. So Bungie, I've never heard of Bungie. So BG. So Bungie Global operates as an agribusiness and food company worldwide. Agribusiness, refined and specialty oils, sugar. Okay. They're a consumer staple. Let's take a look at their website, kind of get our heads around it. Okay. So this is an agribusiness. Okay. And market cap's 14 billion, big revenue, 55 billion, low PE. Target price is 20% higher according to analyst. They have not been growing. I think it's the inflation, right? When food inflation went up, these guys made a lot more revenue. Now that food inflation is down, less revenue, but comparing 2019 to the current trailing 12 months, they are substantially bigger. It's not their fault that overall inflation is dropping. So, okay, that's acceptable. Balance sheet, 1.3 billion in cash. Total debt, 5.9. They've lowered their debt. Looks like they went into some debt during the COVID year, but they're down to 6 billion in debt, and they have 1.3 billion in cash. So south of 5 billion in debt. EBITDA is 2.7. So yeah, in less than 2 years, they can pay off their debt. Good balance sheet. Cash flow. So I'm not overly confident in their cash flow. Negative, 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 negative. Why is it negative? These were like really good years where their input costs just way more expensive than positive, positive. Interesting. Why is there? So net income was good, good. So their accounts receivable really went up. And what's interesting is why didn't it go down in these years? It went up collectively 12 billion. I'm not seeing a 12 billion drop over here. Did they have to write off a bunch of accounts receivable? That's where the money's at right there. Okay. Yeah, this free cash flow it's getting me nervous. I like seeing nice upward slopes, and this one's like a lot of negative cash burning, and then they're up to positive. Now, if I took that number times 10, I'd be at 12 billion, and they're a $14 billion company. This one's not ready for prime time for me. I'm not ready to, invest. I think it'd be an interesting stock maybe to look at in a quarter. And if they start growing and they really get their free cash flow on an upward slope, this might be a good stock to buy into, but it's not at this point. The market's had a couple of like big sell-offs just in the last 12 months. So that erratic reporting on their financials is showing up in their stock price. You can see it. Market wants up and smooth. Okay. Like I showed you Google to start the stream. Other than the most recent year where you saw free cash flow go down because they're, buying into AI, it's up and to the right. That's what the market wants to see. And they'll keep increasing the stock price if a stock is predictable, it performs well, and it keeps gaining value, it keeps getting bigger, expanding revenues, expanding cash flows. So that is Bungie. Let's take a look at Johnson & Johnson. Johnson & Johnson. We looked at this stock recently, and you see this sideways. Whew. It didn't do all that great for the 5-year. It's up just 3%. It would have been a nice pickup here, right? You'd be up nicely. This is a very consistent company. You look at the revenue, it's a big revenue company. It's a big market cap at 385 billion. And it's a decent stock, but I don't know that this one's going to double in the next 5 years. And I looked at this 2-3 days ago, and the result was it just doesn't have enough value and momentum. It's a good stock. It's a good company, good stock. I believe it's a Dow component. If you can show consistent high free cash flows, the company will say, okay, we'll price you at $385 billion. You see where cash flow has a direct correlation to valuations in Johnson & Johnson, but I just don't see a lot of upside. My plays in this space are with Pfizer, are with United Therapeutics, Catalyst Pharma. That's where I'm putting my money. And those are companies that work and operate in the same industry as Johnson & Johnson. Yeah. So I think it's a good stock. If let's say somebody's like, hey, I just want a good, consistent stock, pay a dividend. Hey, Johnson & Johnson all day long. But part of my investing criteria is I invest in stocks for appreciation. I want it to double in the next 5 years. And qualitatively, I don't know that Johnson & Johnson has anything super exciting that's going to be a catalyst. And then when I look at the fundamentals, it's priced correctly. And it's just not proven to be a big appreciating stock. Okay, so that's Johnson & Johnson. Thanks for asking, Tomas. And I'm glad that, Tomas, you accepted the invite for the conference call tomorrow. It should be a good call. We're going to keep it simple. Bring whatever topic you want to the call tomorrow. and we'll talk about it. There's no set agenda. If you wanted to talk about a few stocks, we'll do it. If you wanted to talk about a concept and topic of investing, we'll do that. If you want to share your screen, you can do it. I'll be sharing my screen as much as everybody wants. And the call is really for you guys tomorrow. If you want to learn and grow in a particular area, let's do it. Let's do the call tomorrow. Have a good time and learn something. So, so that is the stream for today. I appreciate everybody who joined, and hopefully I got to everybody's comments. I apologize if I didn't. I'm a one-man show over here. I just wanted to thank all the members who are paid members. I appreciate your support. And I appreciate that James Greaves became a member. I really appreciate that very much. I'll be streaming tomorrow. And tomorrow I'm bringing a crypto. I'm going to classify him as a very knowledgeable expert. And I'm going to do a crypto stream tomorrow. And I'm coaching him that it's going to be really focused on stock investors, just to introduce you to crypto and you get to know about it. I'm not recommending you invest in it, not recommending you buy anything in particular. I just want you to be aware of it. What is it? How can I invest? How can I make money? How can I make income in crypto? And if anything, just know, because it's a pretty good investment for me. I've made a very good return over the last 5 years, and it's gotten bigger. It's gotten more investors over 5 years. I believe in 5 years, I'm probably going to double or more. I'm probably going to do better than double of my crypto holdings. Bitcoin, Ethereum. I have some liquidity pools. Liquidity pools look pretty interesting, but they're really complicated. Hard to get your head around. But I just want to introduce you to the concepts, and at least you'll be aware of crypto and how a stock investor could invest in crypto and potentially at some point make it, a part of your investments or not. It's up to you. And we'll see how it goes. And I'm open to feedback. If you dislike, crypto, please tell me why. Like what's the concern? And I'm happy to take on any questions around it. So let me send you off with a little bit of music. Everybody enjoy your Saturday. Looks like Penn State is on top 17-3. So not only was this a really nice live stream, Penn State has been having a good game. And we're in the third quarter. Penn State's playing at home. It's a sunny day in State College, Pennsylvania. Looks really good. And UCLA is putting up a pretty good fight. It looks like Penn State's got this game under control, and I expect they're going to be winning today. It'll be good to see Penn State win and go to 5-0. The big test for Penn State is going to be Ohio State and Michigan. It's kind of like the final exam when you're in school, right? Those are the big games. And they have some other challenges, like they're going to play USC in a month or so. This one with UCLA, not a big test, but we'll see. All right, enough football talk. Let me see what comments came in. Yeah, thanks, Thomas, for showing up. I really appreciate it. It's great to have you on the live streams, and I hope that you're picking up some knowledge to make you a better investor. It's great that you're young and you're investing. If you get good at investing, you're going to be unstoppable in your journey, in your investing journey, in your life journey. I think you can open doors that you want to open. You can buy yourself a nice house. You can buy multiple properties. You can start businesses. You can have your money working for you. The concept of having your money work at night that Warren Buffett talks about. I love that concept. I love knowing that I go to sleep and sometimes I wake up and I get these big dividend payments. Or like yesterday, my portfolio went up big time. And I love those days when, all right, great. All my holdings went up in value and I didn't really physically have to do anything. All my doing has been over the last, X number of years when I made those investments and I did the analysis. So great to have you and everybody else. Great to have you, Brad. Thanks for tuning in. Mike, I think he left, but thanks for joining. Lighter, thank you, sir. Shadow Guy, the MVP member, thank you, sir, for joining. James, thanks again for joining. And I think those are the names that provided comments. Everybody, enjoy the rest of your Saturday. I am out. Take care.